Dear friends, welcome back to PMS Insights. The last 1 month turned out to be very eventful for the Indian and global markets alike. India overcame a major political uncertainty with the ruling NDA party retaining power with nearly 2/3 majority and India having a stable government for the next 5 years. The market's focus would now revert back to fundamentals and corporate earnings. In our view, the government's immediate priority would be to revive the economic growth. India is currently facing quite a few challenges in the form of consumption slowdown, real estate-led investment slowdown, NBFC sector crisis, and tighter liquidity environment. In the next few months, market participants would focus on the initiatives taken by the government and the Reserve Bank to revive the economy through measures like directed fiscal stimulus, liquidity injection, accommodative monetary policy, and potential transfer of reserves from the Reserve Bank, etc. Today, the corporate profits to GDP ratio is at a multi-year low due to factors such as slow economic growth, stranded assets not generating any returns, short-term negative impact of reforms like GST, and non-performing assets in the banking sector. Historically, we have seen a strong inverse correlation between the corporate profits to GDP ratio and the next 5 years' earnings growth, which means that low corporate profits to GDP ratio is followed by strong earnings recovery over the next 5 years. As can be seen in this chart, currently the ratio is less than half of the level seen in 2007 and is showing signs of having bottomed out. In our view, as the earnings cycle picks up, backed by improving macro and stable government, the stock market divergence witnessed in the last 18 months should get corrected, with broader markets, especially mid and small cap stocks, delivering healthy returns over the medium term. Few sectors that could do well include financials, discretionary consumption, and industrials across market cap categories. In the fourth quarter of FY19, the corporate earnings growth was below expectation. Profit growth for the Nifty came in at 11%, with sales growth at 10%. The financials continue to drive earnings growth for the second consecutive quarter, primarily led by corporate banks. Excluding corporate banks, the Nifty profit growth was flat year-on-year. In this backdrop, the companies in the portfolio performed well, with the earnings hit ratio standing at 80%, which means that 80% of the portfolio companies reported earnings either in line or higher than estimates, and only 20% of the companies reported earnings below estimates. The average profit growth for the portfolio companies stood at 22%. Excluding corporate banks, the profit growth was even higher at 27% in Q4 FY19. Few portfolio companies which delivered strong earnings growth include Bajaj Finserv, Bata, Siemens, RBL Bank, and Shree Cement. New additions in the portfolio in the last quarter include Federal Bank, ICICI Prudential Life, HDFC Bank, and DMart. Most of these companies have contributed positively to the portfolio performance. More than 70% of the CEP portfolio is allocated across financials, consumer discretionary, materials, and industrial sectors. In line with our investment philosophy, the return on equity and net profit growth for the portfolio are at around 40% premium to the benchmark. We believe that going forward, with the small and mid-cap stocks doing well due to valuation comfort, the portfolio might benefit on account of decent exposure to high-quality small and mid-cap stocks. Thank you.